Hey everybody, it's Joey from Universal CPA Review. Some of you might know me as Ask Joey. If you're studying for the CPA exams and you consider yourself to be more of a visual learner, you've come to the right place. So don't forget to subscribe to our YouTube channel, join our Facebook study groups, and our Reddit community. You can find the links to those in the description below.
Let's talk losses. So in this module, we're going to talk about loss limitations for individuals, and specifically we're going to discuss rules for passive activity losses. Okay, so this is going to include a very important exception that's referred to as the mom and pop exception. So this is something that is definitely testable on the exam, but we're going to discuss the rules for this a little bit later on. We're also going to discuss the rules for how we can deduct capital losses for individuals. So let's start by talking about the rules for deducting passive activity losses. So the best way to attack this is starting off by defining what passive activity losses are, and then we can talk about how they are deductible. So passive activity losses are those that come from passive activity, right? The idea behind these investments was to generate passive income. Instead, they generated a passive loss. So the name of the game here is understanding how we're going to deduct those passive losses. Okay, so we need to be very clear that passive activity losses come from passive activity income. So very different from active income and portfolio income. And where this can get a little bit blurry for candidates is understanding the differences primarily in passive income and portfolio income. So let's say that Linda Larper works for Planet of the Grapes Vineyard and Winery. If this is her full-time job, the income from the salaries and wages that she receives will be her active income. Okay, so if she's active in the business, it's not passive, right? So this can include salaries and wages. It can also include any guaranteed payments and any business income from activities that the taxpayer actively participates in. Okay, but if she also invested in Big Bull stock from her Robinhood account on her mobile app, and she received interest and dividend income, as well as capital gains from selling that stock, how would you classify that income? Is it passive income? No, this is actually what we call portfolio income, which is different from passive income. Passive income is her income from her limited ownership in a business. So just because she's a partner in STD Contractors doesn't mean that she is actively operating this business, right? So she's just an investor and sits on the sideline and receives that K1 for receiving her distributions. Okay, so this is going to make this passive activity. Tracy is the one who is actively participating in that business. She's the one that's managing the company, whereas Linda is just a limited partner. So ultimately, this can include any business income from any activity that the taxpayer does not materially participate in. And something else that's important to note is that this will include rental real estate income. So that's going to be considered passive activity unless we meet specific exceptions to that rule. So that's what we mentioned we're going to talk about a little bit later in that mom and pop exception. Okay, but as we said, that concept is important enough to address a little bit later on its own. So again, we're zeroing in on this passive activity because this is ultimately what is associated with how we're going to treat passive losses. And this is what the exam wants us to be sharp on. Okay, so let's talk about how they are going to be treated. These passive activity losses that we speak of are deductible. But what you need to remember is that they will be deductible to the extent of clearing a few hurdles. And ultimately, we are going to use this to offset this passive activity income. Any passive activity income that we don't use will be carried forward indefinitely to offset future passive activity income. Okay, so important to remember that unused passive activity losses can be carried forward forever, but not backwards. Okay, so let's get into it. And we're going to focus on Linda Larper's passive activity in STD Contractors. Okay, so let's say that STD Contractors has a passive activity loss in the current year. And if a portion of that loss is allocated to Linda's individual tax return, how is she going to deduct it? And what we need to remember is that this loss must clear 4 hurdles. So the first 3 are going to be the big ones, but we need to remember the 4 hurdles in general. Okay, so the first 2 hurdles consist of the taxpayer's basis in the passive activity and their at-risk basis. So what's the difference between the two? The difference ultimately comes down to how much risk Linda Larper has in STD Contractors. And when I say risk, I'm talking about liability. So the tax basis is her risk in this interest that she owns, right? And ultimately, what that includes is both recourse and non-recourse liability. So what is the difference between these two? Recourse liability is a liability in which a partner has retained personal liability, meaning they are personally liable for the debts that this company takes on. Okay, so that means that if Linda's personal liability increases, then her tax basis will also increase by that same amount. Whereas non-recourse liability is liability that the taxpayer is not personally liable for. Okay, but most importantly, this tax basis amount will include both recourse and non-recourse liability, whereas the at-risk basis only contains Linda's recourse liability. Okay, so potentially a smaller amount than the tax basis because it's only going to include that recourse liability. If there is any non-recourse liability, it's going to be excluded. And that makes sense in the name alone, right? This is the amount that she is going to be at risk for, right? The amount that she is personally liable for. So let's stop right there. The passive activity loss must first clear the tax basis hurdle, meaning if Linda has a passive activity loss that exceeds her tax basis, the loss can only be deducted to the extent of the owner's tax basis. So we're going to bring this basis all the way down to zero. And if she still has any excess loss, then it's going to be suspended and carried forward indefinitely. But this amount can only be used to offset future tax basis. Okay, so that's hurdle number one. Hurdle number two is clearing the at-risk basis amount. So once the remaining passive activity loss has exceeded the at-risk basis amount, it will have cleared hurdle number two. And any amount from this loss that is in excess of this at-risk amount will be suspended and carried forward indefinitely until there is more at-risk basis. And finally, now that we have cleared hurdle number one and hurdle number two, the tax basis and the at-risk basis, we can now offset the passive activity losses. And we can do that to the extent of any passive activity income. All right, so of this loss, this is the amount that we can actually deduct. And again, any remaining excess of this amount can be used to offset future passive activity income. And then we have our excess business income loss limitation. And now we're saying that we have a maximum threshold for individuals and married filing joint taxpayers. This is the total aggregate excess business income for the year. So this is our limitation for individuals, and this is our maximum limitation for married filers. Okay, so I know this is a lot to take in, but it'll start to make more sense once we go through an example. Okay, so let's dive right into it and take a look at a quick example. Jane is a single filing taxpayer and has a 30% interest in EVA partnership. Okay, so in addition to that, she has the following information. She has a basis in the partnership of $60,000 and an at-risk basis of $50,000. So what we remember about basis versus at-risk is that the basis will include both recourse as well as non-recourse liability, whereas the at-risk basis is only going to include the recourse liability, aka the amount that Jane is on the hook for, right? This is the amount that will hold her personally liable. So the difference between the two would obviously give the non-recourse liability an amount of $10,000. So what else did Jane have? She had W-2 wages of $120,000, and she had income from the BTO partnership of $20,000. All right, she also had interest income of $25,000. So what do we know? We know that Jane has no active operating duties in EVA partnership, so therefore she's a limited partner. So if we assume that EVA had a $300,000 loss in the current year, that's going to indicate that this is a passive activity loss. But wait a minute, Jane only had 30% interest in EVA. So the amount of passive activity loss that will be allocated to Jane will be 30% of $300,000. So now we know that Jane's passive activity loss from EVA is $90,000. So does Jane have any additional passive activity losses? No, she doesn't. She only has other income, right? We know that W-2 wages is going to be considered active income. We know that interest income is not passive activity income, right? This is portfolio income. So the only passive activity income that we're working with will be the income from BTO partnership. So the $20,000. All right, great. Now we could go through our hurdles. Hurdle number one is going to be our basis. Okay, so the $90,000 passive activity loss that is attributed to Jane will be limited to $60,000. Right? That's the amount of her tax basis in the partnership. So that means that the $30,000 excess will be suspended and carried forward indefinitely. So what does that mean for Jane? It means that Jane can apply the $30,000 suspended loss only to offset future basis amounts. Okay, so hurdle number 1 is complete. At hurdle number 2, we're dealing with the at-risk basis. Okay, so of the $60,000 remaining deductible losses, Jane's next amount will be limited to $50,000, right? That's her at-risk amount. So the excess, the amount between the basis and the at-risk basis, will be $10,000. Okay, so that's the amount that will be carried forward indefinitely to offset future additional at-risk amounts that are reinstated. Okay, so AKA if Jane goes out and acquires more recourse liability. Okay, so now what are we left with? We have $50,000 in possible remaining losses of the $90,000. So Jane's deductible amount will next be limited to $20,000. Why is that? Because that's the only amount of passive activity income that Jane has in the current year. So the remaining $30,000, right, the difference between the $50,000 remaining at-risk amount and the $20,000 total passive activity income, will be suspended and used to offset future passive income. So how much can Jane deduct in the current year? Up to her $20,000 passive activity income amount. That is her limitation. Okay, so when we think about hurdle number 4, excess business losses, we just remember that the max amount that she could take in the current year would be limited to the thresholds for both married filing joint taxpayers and, in her case, for single filers. Okay, so we're saying the max amount that she could deduct is this maximum threshold amount. All right, but in this case, we're not worried about that because we're limited to the passive activity income. So if her passive activity income was this crazy high amount that exceeded this threshold, it is only then that we would worry about the excess business loss threshold. Okay, so let's think of this quick alternative scenario here where the taxpayer sells their limited partnership interest in the current year. Okay, so in other words, the company is being sold. Okay, so thinking about Linda and thinking about the fact that her partnership interest is being sold in the current year. Okay, but she still has all of these suspended passive activity losses, right? The losses that are being carried forward due to insufficient basis, due to insufficient at-risk basis, and due to insufficient passive activity income. Right, so these losses are getting carried forward indefinitely, but now the company is being sold. So how will Linda be able to treat the suspended carried forward passive activity losses? Okay, so in layman terms, what can Linda still deduct? Is she allowed to use the carry forwards after this business has been sold? So in this situation, you're going to remember worst to best. Okay, so worst case scenario to best case scenario. So here the rule is we cannot deduct suspended passive activity losses due to the lack of tax basis. Okay, so if we have a gain from the sale and we have suspended passive activity losses that can only be used to offset future tax basis, those suspended passive activity losses are no longer going to be deductible. Okay, so poof, they are gone. They are permanently lost. That is worst case scenario. Okay, how about the at-risk basis suspended carry forward? This one's a little bit different. Okay, so this one is a little bit more tax advantageous, right? Remember, worst to best for the taxpayer. So suspended passive activity losses due to insufficient at-risk basis can be deducted from the gain on the sale. Okay, so only from the gain on the sale. So the partnership that Linda is invested in sells off the company. Linda's suspended passive activity losses due to the insufficient at-risk basis amount can still be used, but only to offset the gain from the sale of that company. Okay, and finally, what about this third hurdle, this suspended passive activity loss carry forward? So this is best case scenario here, right? So here what we're saying is if Linda has any suspended passive activity losses that are carried forward and can therefore only be used to offset future passive activity income, what we're saying now is that suspended carry forward amount can be now used to offset any income. So that can be any active income, can be any portfolio income, can be any passive activity income. So any income possible can now be used and can be offset by this suspended passive activity loss. Okay, obviously that's going to be the most advantageous situation for the taxpayer. Okay, so when in doubt, remember worst to best when we're selling off passive activity interest.